Hello everyone, welcome back to the channel. Today we will be doing a book review of Once Upon a Time in Bursa. It's one of my favorite books, definitely one of my favorite books from a Malaysian author and a friend. And I'll be doing a review, but of course none of what I say should be taken as financial advice. Speaking of books, if you're interested in finding out some of the important steps you need to take to achieve or to build a six-figure portfolio of stocks from essentially zero, you need to check out our free ebook, which you can find and download in the comment section or the description. Alright, so before we begin, let's set the context or the background on Mr. Ng Zhu Han, who is also a good friend. He is a practitioner of long-term, some might say long-term value investing. He wrote the book Once Upon a Time in Bursa, which is what I'll be reviewing today. He is a lawyer by training, and he is currently the founder, right, of Tradeview Capital, which is a boutique fund management company licensed by SC of Malaysia. I think they only started in April of 2022. So he's a good friend, and he has also appeared on our podcast several times already, so do check it out here. And we'll be getting some of his team members on soon as well, so very exciting stuff. Now I'll go straight into the review, and I'll share with you what you can expect and what I like, and also a little bit of criticism right at the end, right? And that is, the first one is all the examples that he gives for the stocks that he picked and profited from are Malaysian. So there's a lot of case studies, and I like the fact that he uses case studies because he shows you like real life application of theory. So he mentioned companies like QL, Dotcom, Oriental, Ajinomoto. Ajinomoto is Japanese, I understand, but it's listed in Malaysia. And RCE Capital, the financing company. So what I find interesting about this is, especially today, in today's age, and a lot of Malaysians, especially young ones, they tend to have this idea that abroad is better, right? The grass is greener on the other side, and maybe it is for certain people, right? You can make money anywhere, whether it's the United States, China, Zimbabwe, Indonesia, doesn't matter. However, it's important to also take note that such opportunities are also afforded to you as a Malaysian. And some of these stocks like QL, Time, RCE, these are like multi-baggers, especially QL and Time, right? Some of the other companies that he mentioned in the book that are not here are things like MFCB, another big multi-bagger. So it's a total myth that you need to go abroad to do well in investments. And in fact, I would argue that because you are here, you may have an information advantage over the rest, but that's another conversation. And why I say this is because it was quite interesting that last year, I think like June or July, a lot of people were coming up with videos and sharing their thoughts on Facebook, and also in person they're saying Malaysian market cannot want this and that, and they straight away hopped into the US markets and they started investing in the tech stocks for US, and we know it's like one of the worst performing market right now as of this recording. So again, there's no like free lunch. It's not easy, and just because you get more information in the United States doesn't mean it's an advantage, right? Because guess what, if you have more information, so do other people as well, so it's not really an advantage. Whereas in Malaysia, there is that option for you. But again, it doesn't mean that Malaysia is better, or it doesn't mean that the US is better. What matters is what advantages that you have, what are your interests, and if your interests are US software companies, then that's where you should be investing. So the next thing I like is that the book keeps things simple, right? The principles are amazingly clear, right? There's a lot of clarity. Sometimes books about finance can get very complicated. There's a lot of numbers and equations and whatnot, but Mr. Han's book is excellent in this department. typo here, it's not but, it's buy. Some of the rules that he mentions are very timeless, and one of them is that buy stuff that will be around, right? Buy stuff that will be around, meaning to say, right, that it doesn't matter whether 5-10 years time they're likely to still be providing services, because you're almost guaranteed to do well the longer you hold a stock, right? Some interesting stats, right? If you hold a stock for a day, i.e. you day trade, the chance of you losing money is something like 56%, right? Essentially, it's a coin flip. But if the chance of you making money in 5 years in 1 year, there's a 60% chance of you making 10% if you hold it for 1 year. And if you hold it for 10 years, you're essentially guaranteed to make money. The caveat is that you need to buy stuff, companies that will be around. So, all the companies mentioned here, like Time.com, QL, these are companies that will very likely still be providing the same kind of services or maybe superior services in the future, and as such would represent more interesting opportunities for you. The other advantage of keeping things simple is that you don't really fear downturns. So when you see your portfolio drop by 20%, 30% or more, most people will panic, right? And the reason most people panic is because they don't actually understand what in the world is going on with their stocks. And why don't they understand what in the world is going on with their stocks? That is because they don't understand it. And why don't they understand it? There's a good chance that it's not a very simple business to understand. And of course, on the financial side, again, keep things simple, right? You want resilient balance sheets, i.e. companies with a lot of cash, or at least if they do have debt, it's very manageable. And then the next portion is something that we also talk a lot about, and that is you want to have excellent cash flow as a company. So all this, when you add it in together, it's going to keep things simple for you. And not to say it's going to be smooth sailing, right? Psychology still plays a role, but at least you have a lot more comfort and certainty of success. Now, this third one is be small. Be small. What do you mean by be small? Han wrote in the book that little guys can win. And this reminds me of Peter Lynch. Is he the Peter Lynch of Malaysia? We shall see. But little guys can really win in this market, right? And why? Is because they have this thing called pivotability and speed, right? Pivotability means, case in point, right? Let's say you invested in the oil and gas sector, and you feel like, and if you're a little guy, maybe you have a few thousand or even low millions. You invested in the oil and gas sector, you're excited about it. Then you read certain data that things like, hey, actually it's not as exciting as I thought. What do? You just sell, and then you just put it in cash, or you go and buy something else. For a big fund, right, maybe whether it's unit trust, banks, insurance, whatnot, they won't be able to do it so quickly, right? They have to sell in batches, and they have to sell in a way that doesn't move the price. And and they may never be able to pivot fully, right? And so they lack that speed. It's like a big tanker in the ocean trying to change direction. It's very, very slow. But you, as a small fry or a little guy, you don't have that issue, and as such, you are able to be very nimble. This link to being small is the fact that you are able to be early, right? So let's say you find a stock that's doing very well. Case in point would be QL Resources, right? When they got listed, they're only like 100 million market cap thereabouts. Very small, too small for institutions to really care about. So what this does is that if you as a retail investor or little guy is able to identify a company like that, you are able to be early. Because let's say even with a free float of 20%, right, at 100 million market cap, that's 20 million. Unless you have 20 million, you'll be able to enter that free float a lot easier. But if a fund has $1 billion and they want to allocate just 5% of their portfolio into this company, even if they discovered it the same time as you did or even earlier, that's 50 million. They won't be able to buy it. They can only buy a little bit of it, whereas you can buy a lot of it, right? So that's a huge advantage. And of course, sometimes because these companies are so small, these big funds where all the smart and analysts are, won't spend time looking at this, which only means that you've got, it's a demand and supply situation. The demand for good the availability of good companies is there, whereas the eyeballs looking at it quite low. So that's a one big advantage. As you can see, you can essentially go for low stocks with low coverage. And of course, linking to my earlier point, once you are small, you can't actually move the price. And so why a lot of people say that, wow, he's a big player and he can move prices, therefore it's good and all that. I actually think that it's a disadvantage that you can move the price, because let's say if you find a good company, you've got the money ready to buy. Every time you put in few 100,000, the price starts to move. And so what happens is your average cost keeps going up. Whereas if you're a small guy, you can just buy it at the price, whatever is listed in the stock, in your brokerage account. So that's one big advantage as well that Han hampers a lot in his book. Alright guys, enjoying the video so far? If the answer is yes, give it a like. And even if the answer is no, let us know in the comments. And of course, don't forget to subscribe, click on the notification bell so that whenever new videos pop, you know it fresh. So the next bit that I really like about the book is that Han has a very interesting view on diversification, and he calls it defense. Diversification is defense. And he advocates diversifying across different sectors. Now, this is where I would come in, and I would say that I don't outright disagree, although the point I will add here about diversifying across sectors is that if you have expertise in a sector or two, it is not wrong to fill your portfolio up with just two sectors, right? So out of 10, 5 are in, let's say, oil and gas, 5 are in semiconductors. It's not wrong because you have expertise into this. However, taking Han's approach, which is closer to, let's say, out of 10 stocks, you have only maximum 1 or 2 stocks in one industry. That can do well as well. In fact, once you become a more experienced stock investor, what you realize is that sometimes you get a bit bored with just looking at one industry, so you want to try other things out. So that helps diversify the mental energy as well. But I digress. Diversification is really important, right? According to Han, and that is your best form of defense. So case in point, from 2016 to 2020, Han actually, based on what he stated in his blog and also the book, if you calculate, that's a 26% per annum return. That's really good. You're doubling every 3 years, right? Or less than 3 years. That is alpha, right? That's really, really good stuff. And because of his diversification, diversifying into 10 different industries, he wasn't worried about the crash that happened in 2020. In fact, a lot of the stocks he listed out were down like 40-50%. In fact, it was an opportunity for him to add even more, right? So if you invest in one sector only and there's a downturn, you have to ask yourself, wow, will this sector like pick back up, right? And that can take a drain on you. And so that is something I find something very interesting about the way Han diversify his investments. And hold on, yes. Now the next week is he goes into like, how do you what are your information sources? B, what is useful and what is not useful. I find that very useful. I know, pun intended. So the first thing you want to do is that you want to avoid short-term trading as retail investors, according to Han, because as AI and high-frequency trading start to become more prominent, those short-term moves that you want to take advantage of, some machine is already taking over, right? What machines tend to not be very good at is the long-term kind of investing, and that's where you should be focusing your energies into. Now, the 5 sources of information that he talked about would be media. And obviously, media is good in the sense that it's filtered, right? You can't just write for any newspaper. However, you have a situation where certain media aims for viewership, right? Viewership equals revenue for a lot of traditional media companies. As such, when viewership becomes king, facts and insight might take a backseat. So how about forums and blogs? So your i3s of this world and whatnot. The issue there is that it's a hit and miss, right? You have accuracy problems. But the good side is also that you may have industry insiders talking about the stocks that can give you an information edge over everyone else. So that's forums. Then you have social media. Manipulation is very, very real. People put flashy cars out there for you to see and be impressed with, and then you think, wow, that means he's a good investor, so whatever he says become very good. That's not a very good way of thinking. Then somewhat linked to that is seminars. So seminars is outright not a bad thing, right? Because you want to connect with people and you want to see the guru in person. But it does have cult-like or guru, what I call guruism, right? Where suddenly the personality becomes more important than the actual content itself, and the content is what's gonna help make you money rather than the guru itself. So it might create almost like religion, right? Where people follow certain people because they trust their advice a lot, and that is not healthy for independence of thought. And the last bit, which is quite tricky, and that is analyst reports. So by and large, analyst reports have a lot of integrity, right? Good information, structured information, maybe even insider, I wouldn't say insider information, but certainly industry insights, right? That it's hard to find in public. And so the big banks or in Malaysia or abroad, they do provide very good reports. However, there are also conflicts of interest, right? Sometimes you think because these analysts can write so well, therefore whatever they say is true and that they are on your side. That means when they present to you the information, it's useful for you. But there are cases where they will, join hands with the companies itself to say, hey, the companies will say, hey, Mr. Analyst, if you write a very good report, I'll pay you some money in a different way. And that is something that definitely exists in the analyst industry or the fund management industry that you need to take note of. So whatever it is, at the end of the day, the ability to develop a framework that makes sense, that allows you to be independent and not be swayed by the crowd left or right is absolutely crucial, because it doesn't matter which information sources that you go to learn, you will face problems despite their apparent benefits. And of course, to summarize this point, every sources of information can be useful. You just need to know what are some of the downsides. And I think the last bit, which is a more important part about investor psychology, is that you need to get used to being alone. Now, this doesn't mean that you should be alone, right? That's why we created this channel for you guys, so that if you're interested in being long-term investors, fundamental investors, this is the channel for you to meet other people and to learn about how exactly you should be objective in your analysis. But you ought to get used to or prepare yourself to be alone, right? Because very often you'll be doing the opposite of what your friends and family and the market in general is doing, right? By definition, to do well in the stock market, you got to be doing something different. So Han advocates that you need to be consistent, right? People like the flashy moves. People like the sexy tech stocks. But the reason Warren Buffett, the reason someone like even Han has been able to generate very good returns is because they just do the simple stuff when everybody is doing crazy stuff. And it's really that simple. Once you get used to being alone, what this does is that it helps you develop strong convictions in the face of opposing pressure. So when everybody is telling you to sell during the COVID crisis, what you need to do is to buy. And when everybody is telling you to buy, that's probably when you need to sell. And I like this point that Han made very well, because I hear so many investors tell me that, hey, you got to swim the sharks. Don't, you just follow the smart money, right? Then you'll be safe. These are what we call momentum type traders. And certainly there are people who can do it very well. But by and large, if you have this mindset, that's very, very dangerous, right? Because you are following the crowd. And you are potentially arrogantly thinking that you follow the crowd, and just as they are about to fall off the cliff, you are able to change direction. In reality, in theory, that sounds good, but in practice, that's not very, very easy. So it's a lot better to have your own anchor and your own strong convictions to say, no, this is what I'm going to do, no matter what happens around me. And this might be seen as stubbornness, right, to be fair. But I think over the long run, especially if you hone yourself by, learning, constant learning, then conviction becomes a lot more relevant and a lot more powerful. Another thing that Han mentions is that, don't be an I told you so type, this is a big problem with social media and also online forums and blogs. A lot of people like to say like, you see, I told you not to buy that. Or I see, I told you to buy that. Why you never listen to me? That's not helpful behavior, right? You gotta build people up rather than try and show the world that you're a great investor and you know so much. So that's not good. And like I said, right, the reason to become a good investor, you need to be alone. The reason is because you're just not doing what the market is doing, and you will look like a fool for a long time. In fact, I read a stat some time back that the investors with the best performing investments and funds tend to underperform the market 2/3 of the time, or even 3/4 of the time. But that 1/4 of the time where they outperform the market, they're outperforming by a huge margin. So yeah, guys, that is the end of my review. But just to summarize, I think this book is really simple and it's sufficient for you to learn some of the timeless principles that you need to be successful in investing. And because it's so simple, the certainty of success is quite high, assuming that you follow what Han wrote in the book. Now, some downsides is this: even though it's simple, it's not entirely basic. If you are a first-time reader, it might be hard. Where I wouldn't say there's a lot of jargons in the books, but certainly it requires some basic understanding of finance in order to appreciate it. And the last bit is that if you're not already interested in the subject, it can be a little bit dry. But that's just my personal opinion. If you guys have already read the book, let me know, right, in the comment section whether you agree with my review, and maybe if I miss certain things out, also do let me know in the comment section. And guys, this is the end of the review. If you feel that someone needs this book or is considering buying this book, please share this video with them. Follow us on our social media page. Go get Han's book, right? I think we'll put it in the comment section, a link to buy. And I will see you in the next video.